Join me in this video as we break down Warren Buffett's simple pieces of advice that can really work for anyone. When you think of Warren Buffett, he is one of the most successful investors that we've seen in our time. And the advice that he doles out there, I always do put into application. A lot of people take the advice, they take it with a grain of salt. They really don't apply it. But if you think about it and think about the fundamentals of this, anyone can do this regardless of who you are. So let's go ahead and get in this one. The first one we look at is starting small and being patient. This, of course, can be applied to investing. It can be applied to a ton of things in your life, but specifically thinking of the investment side of it, if you're putting away $5, $10 every paycheck, if you're putting away $100 a month, starting small and being patient, of course, is going to grow that investment with the compounding interest as long as you're continuing contributions over an extended amount of time. So if you're 18 years old, 20, 25, when you start making 401k contributions, when you start investing, that is really starting the snowball rolling, regardless of how much you have at that point. Once you start that moving, it can move faster and faster as it's growing through the years, as the contributions continue to go, as you're making more of a dent towards that retirement goal that you have, it is going to make a big difference. Now, the next one we look at is investing in index funds. If you caught my video yesterday, the VOO is the index fund, tracks the S&P 500. When you think about this, in my view, for most people, the best thing to do is own the S&P 500. That is from Warren Buffett. He said everyone should own the S&P 500 index. It is really the set it and forget it, putting money in there on a consistent basis, even looking at our first step of making it really simplified, doing it on a constant basis, and of course, giving it time to grow is going to make a big difference. Now, the third one we look at, and this one for me is a little bit more questionable, looking at bonds. He puts 10% or more of the entire investment portfolio into short-term government bonds. Right now, the bonds are paying a lot of money, so it is beneficial. And I know he put billions of dollars into bonds right now. Personally, long-term, rolling over government bonds, it can make a big difference for stability if you have a lot of money to put in there. But overall, bonds are something that I wouldn't put in. Even looking at BND and a couple other ETFs that kind of group bonds together, bonds I wouldn't. And again, we have to take the advice as we get it. Treasury bonds and bonds in general, I wouldn't put in the portfolio. We do not see the growth that we're looking for in a portfolio. Next one we look at is understanding your investment. Risk comes from not knowing. This is one of my absolute biggest pet peeves when it comes to investing, when it comes to finance, when it comes to financial counseling. Never invest in something you don't understand. If it is ETFs, if it's stocks, if it's bonds, if it's cryptocurrency, if it's REITs, if it's real estate, you have to know exactly what you're getting into, what the risks are, and understanding exactly how that product works. If you do not know, and I always tell these individuals, especially around that cryptocurrency, if you do not know the ins and outs of cryptocurrency, if you don't understand it, do not invest in it. Don't follow the crowd, don't follow the herd, do not invest it in if you do not understand it. And of course, when he talks about understanding your investment, you don't need to know it so well that you can recite it, verbatim, everything. But you have to know exactly what the value is, what it does. When we talk about blockchain technology, when you talk about a lot of things that are around that crypto space, do you know exactly what it is? And do you know it well enough that you could explain it to another individual? Definitely take that again with a grain of salt. And then we think, don't follow the crowd. This one is really, really important. This is when you think of following the crowd and when you think of the subconscious investing, this is where people get it wrong. In my opinion, when we're looking in here, it is not about the temperament and really the temperament that you have in investing, not about the intellect. When you're looking to weather the storm, and we have said this before, when you think of shopping, so let's say you're retail shopping, they have a really good deal at a store. You're going in there, you're buying more, it's 30% off, 40% off, 50% off the price. You're going to be buying a lot more than you normally are because it is at a discount. Now, when it comes to ETFs, when it comes to investing, when it comes to stocks, people psychologically and emotionally see the exact opposite. When I see a market in 2022 that's down roughly 20 to 25%, that is a massive buying opportunity because everything that I'm getting in the market is at a 25% discount. And of course, they say buy when there's blood in the streets. When the market is red is your best time to invest and the best time to buy. Now, unfortunately, what we normally see is when stocks are going up, look at NVIDIA, people just start piling on. They are following the crowd. They are really dumping a ton of money into a company like NVIDIA. We know they're doing incredibly well, but now the price to earnings ratio has literally just went through the roof. Valuation has went through the roof because nobody wants to miss out on the growth we're seeing. Not saying it can't happen to some companies, but there's a lot of companies where people follow the crowd and they get completely burned. And of course, when you think about the negative market, when you think about it on sale, keeping cash on hand. When your bills come due, only cash is legal tender. Don't leave home without it. That is a huge piece of advice for a majority of us. When bills come due, only cash is legal tender. If you have money tied up everywhere, if you're literally not saving anything at all, you're not going to have the ability to cash flow. You're not going to have the ability to pay your bills back on a timely manner, which of course can affect your credit and everything else in your life if you don't have the ability to pay that off. And when we think about paying bills and when we think about that, paying off credit cards, people should avoid using credit cards, should avoid using credit cards because it is at a piggy bank to be rated. That is how people see credit cards. And it's kind of crazy. Let me read that one more time. People should avoid using credit cards as a piggy bank to be rated. This is where we're sitting almost $1.2 trillion in credit card debt. They are people, and honestly, a lot of people are supplementing their income in credit card debt because they're not budgeting, they're not spending plan, they're not really thinking of future them and getting it under control. They are living outside of their means to supplement their income. Again, that is where the credit cards are coming in. When you think about credit cards, when you think about in conjunction to debit cards to paying cash, people that spend and utilize credit cards on a regular basis really spend about 20 to 25% more than debit card users. And the reason is the justification of rewards programs, which again, that's a whole nother part I don't want to get into in this video, but it is kind of crazy. Now, when we think of Warren Buffett, we think of value, not the price. Price is what you pay. The value is what you get. That is really, really pivotal. Price is what you pay. Value is what you get. This can be applied to everything when it comes to frugal living, when it comes to being able to pick companies, pick stocks, ETFs. The price is what you pay. The value is what you get. What is going to be beneficial? What is going to give you assets? What is going to grow your net worth? What is going to build your portfolio? It is huge. Really looking at that again wholeheartedly. Price is what you pay. Value is what you get. And we know he is a huge, huge value investor. Now, when we look at the next one, buy quality at lower prices. Whether we're talking about stocks or socks, buying a little bit more of the quantity merchandise when it is marked down. So again, thinking of this in the education aspect of it, when the stock market's on sale, when we're seeing a dip, when we're seeing a decline, this is the time when people should be buying more. But unfortunately, like I said, this is normally when people start running for the hills. We're not going to see a lot of influx of cash to the market. Everyone is liquidating, everybody is selling when they should be buying and when they should be buying on a bigger level. Now, when we think about acting on opportunities, opportunities come infrequently. When it rains gold, put out a bucket, not a thimble. Again, the words of advice from Warren Buffett, I absolutely love it. When it rains gold, put out a bucket, not a thimble. That again can be really true. When you see an opportunity, a lot of people are very afraid to go for it. There's not going to be perfect conditions. You're not going to be timing the market. It is near impossible to go ahead and time the market. But when we look right now and thinking again, kind of in the stock market, artificial intelligence has really started to take off. Next 3 to 5 years, probably even 10 years, there is going to be a lot of growth in technology. There's going to be a lot of growth in companies' utilization, not only in the development of the AI space and technology itself, but also thinking of the utilization in really big picture using AI for everything. We're starting to see it in education. We're seeing it in the workspaces. So investing in companies like this, when opportunities come like this with artificial intelligence, I feel like this is one that we definitely cannot miss. And of course, never lose money. First rule of investing, don't lose money. Second rule of investing, never forget that first rule. That is right. That is why the rules are out there. That is why he follows them. And of course, looking at Berkshire Hathaway, they have done incredibly well since their inception. Even when you look at the companies, it's not too flashy. It's not too crazy of a portfolio that he's running, but he holds a lot of the exact same things and just more in bulk. When you think of Apple, when you think of Bank of America, when you look at Coca-Cola, he doesn't have a crazy amount of money in a ton of different things. It is more kind of kind of concentrated when you look at the portfolio of Berkshire Hathaway, even looking at the AI bets that he makes. A big chunk is in Apple. He sees value in the company. That is the reason why, again, I know he moves around money and the portfolio might change a little bit, but overall, you can see that there is value with what they're doing it. And of course, with value comes a margin of safety. When you think about safety, this of course gets back to our emergency fund, making sure that you have money on the sideline, making sure you have money just in case. You have to have that emergency fund before you get into really paying off and eliminating all of that debt, getting rid of the credit cards, saving and investing a lot of money. The more money that you're putting towards interest will be detrimental to the portfolio, but having that emergency fund will not put your entire reliance onto credit cards, onto borrowing money. You want to make sure that the savings account you do have fully funded before we get into this investment journey. And of course, the final one in here, focus on the game, not just the score. Games are won by players who focus on the playing field, not the ones who are watching the scoreboards. That's right. You have to put your head in the game. You have to understand exactly what you're investing into, how you're going to do it, what is the game plan. This is the reason when it comes to really setting financial goals, using SMART goals, this is where the game is played. When you think, okay, well, I want to invest $100 a month and I'm going to do that, I'm going to put it into the S&P 500. We're going to go with the Vanguard S&P 500, the VOO. That is my game plan. I'm going to stick to that game plan. If the market goes up, great, we're buying a little bit less. If the market goes down, perfect, we're buying a little bit more. It is about sticking to that game plan regardless of what the scoreboard says. If you see the value of your stock or your holdings go down, a lot of people will liquidate it, not knowing that, of course, it is going to rebound. And we have years like this year where the S&P 500 is up about 17 to 19%, which is incredible. If you would have pulled out your money years ago, you could have missed on the really, really big gains that we see. So of course, when it comes to investing, it is simplified, and keeping it simple is the way that we're looking to do this. When we look at the 3-fund ETF portfolio, which I have a video on that, we are keeping the investment. And it's funny because I have actually got a couple comments about that video saying your portfolio is boring. Your portfolio is very simple. Perfect. That's exactly what I want to go into. When I put money into my portfolio, the three ETF portfolio, that's all I do. I put money in there every single 2 weeks. It has been growing kind of crazy over the last 3 years. So we are just coming up on the 3-year anniversary for the individual brokerage account through M1 Finance. I have some links down below, but looking at that portfolio itself, we are up about 80% as of today, which is incredible to think when it comes to a very basic and simple portfolio. It is up about 80% in 3 years, which means we could look, if it continues this year, we could double and have doubled our portfolio within a 3-year span, which is, again, kind of incredible to think that we've seen that growth. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.